Hello and welcome to Market Drop, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICIdirect. Very good afternoon, Pankaj, and welcome to the show.
Yeah, hi, good evening, Geetu.
Pankaj, markets are getting a little boring. Quite a bit of range that we're seeing for Nifty. What are the chances of Nifty breaking out of this narrow range? It has been trading in since the beginning of 2023. If we talk about the corporate earnings, they are on expected lines. Inflation is cooling off. So, what is keeping the markets on the edge?
So when we sort of look at last week, we haven't seen much of a movement in Nifty. I think Nifty has been in the range of about 100 points or probably even lower. I think the only sector which did well, exceptionally well, was the IT because of the good set of numbers by most of the companies. And the other interesting thing is that what we are seeing is that Nifty has been making a strong base around 17,800 kind of a levels. And last 4 weeks, markets have been taking support at these levels, and these levels are again 50% higher to the kind of rally what we have seen earlier. So market is obviously making a higher base and consolidating at those levels. I think the another interesting thing is that we have seen FI outflow of about $1.6 billion in the first week. But
Yes.
since last Friday, we have seen FIs have sort of turned bias to the tune of over 3,400 odd crores. I think the
Right.
cash volumes are still sort of tepid. Probably what is holding markets as of now is that there is a concern that if there could be some readjustment in terms of taxes on capital gains. That is what is probably keeping the markets edgy. Otherwise, largely corporate earnings are on expected lines. In some of the sectors where there is not earning growth, say for example, FMCG or consumer durables, the expectation was that you will see margins recover both gross as well as EBITDA margins on a quarter-on-quarter. So that is largely panning out. So I think it's a sort of a good base formation at higher levels which is happening, and our sense is that probably going forward, markets would edge higher to something like 18,900 kind of a levels. I think budget remains the key event to be watched for. Otherwise, we'll continue to get stock-specific moves the way we have been getting in some of the IT stocks and other sectors also.
Pankaj, what are the chances that FII will return back to our markets? I mean, they might be waiting for the budget outcome.
No, actually, FIs have sort of turned buyers since last week. If you look at, they have sold about $17 billion last calendar year. And in the first 2 weeks of this calendar year, they had sold about 1.6 or $1.7 billion. Now, since last week, they have sort of turned buyers, and largely, again, it's very stock specific. So our sense is that big companies like, say, HDFC Bank is attracting some buying interest, largely because of the fact that probably merger-related uncertainties are towards the fag end. So, and we haven't seen much of a price performance. The stock is attractive at about 2.4 times adjusted book basis. And mind you, this is one stock which attracts a good amount of FI interest. So in general, our sense is that banking after rally has witnessed some correction and numbers have been steady. So it's a matter of time where the banks will also sort of participate. Typically, banks and IT are sort of two sectors where the FI exposure is a lot more higher.
Pankaj, talking about the IT numbers, this time they have really given a surprise. Nobody was expecting these kind of numbers from IT majors and the strong pipeline that they have been talking about. So tell us something about persistent system numbers. They have also been bang on as per expected.
Absolutely. I think when you sort of look at IT numbers, when we entered the IT result season, there was a broader consensus that we could see about 30 to 70 bips kind of a margin expansion. And largely this was the quarter which was expected to be softer, not much was expected. Now, you sort of look at for growth for most of the companies, the growth, the dollar revenue growth quarter on quarter has been better. And also the margin expansion is on expected lines. I noticed that the kind of TCV or the deal wins a lot of these companies are sort of delivering, especially in double digits, which is why the entire mood in the IT as an overall pack has changed. Now coming specific to persistent, now this is where the total contract values have gone up by 20% quarter on quarter. This is the only company which is talking about pricing increase in most of their projects or most of the businesses what they do,
Mm-hmm.
and
Mm-hmm.
also overall they are pretty confident of double-digit kind of a growth rate,
Mm-hmm.
and attrition also is on decline is also on the expected lines. That way, I think there is very little to complain, and also even from a spending perspective, they are not sort of that much worried, and they're talking about acquiring more companies, especially on the cloud side. So I think a good set of numbers, not only from Persistent but other companies as well.
Mm-hmm. So, would you be a buyer in Wipro or Cyient post the quarter three numbers?
Yes. When we sort of look at Wipro, now Wipro also came out with a number which was at the lower end of the guidance. But I think the good part is that the total contract values has sort of remained strong at about, and which is why our sense is that even if we sort of take a normal execution of conservative book-to-bill ratio of about 0.75 times, we would
Mm-hmm.
expect digit growth even from Wipro. So from that perspective, I think Wipro is one stock which has been sort of beaten down substantially. It's trading at about 13, 14 times. And since the order book values have been good, we have given a buy rating on the stock with a target price of 455 at about 16 times FY25 EPS. I think
Mm-hmm.
Cyient is one company which has also come out with a fabulous set of numbers. I mean, this company was confident of delivering 20% kind of a growth in this
Okay.
year, and actually they've upped the guidance to about 22%. They've
Mm-hmm.
reported about 20% kind of a growth, though organic growth is about 3.7%. But they have
Mm-hmm.
seen one of the highest order intakes. And this is one company which has got the least trouble on the attrition front. And then
Mm-hmm.
there is a overall guidance of 3 to 4% kind of a growth rate. So from that perspective, this company also looks quite attractive. We had a previous buy rating, and we are maintaining a buy rating on this stock with a target price of 1,020. So I think most of the IT company numbers have come out with good. I think the only disappointment what you see in our coverage has been sort of emphasis, where there is a
Okay.
decline of about 2.8 odd percent quarter on quarter. Now the
Mm-hmm.
challenge is that the company is heavy into mortgages, and we all know that the US Fed has been sort of hiking rates pretty aggressively, and
Mm-hmm.
which is witness the pain in this particular quarter. The pain is still expected over the next 2 or 3 quarters. So this company will
Okay.
continue to struggle. But in
Mm-hmm.
general, most of the IT companies have come out with good set of numbers. The other interesting opportunity which is sort of coming out is on the vendor consolidation phase, consolidation which is expected. Now, companies like
Okay.
Infosys, HCL Tech, or Persistent, so all of them have been sort of beneficiary of vendor consolidation. So this is another interesting thing which is sort of helping most of the IT companies outperforming, and we have seen IT as a sector really sort of doing delivering 3% kind of a return in this particular week itself, when the Nifty
Yes.
has actually not done anything in the
Mm-hmm.
last week.
Mhm. What we are hearing from the World Economic Forum is that global economies are likely to slip into recession by the end of 2023. If that is the case, Pankaj, should there be a staggered buying in IT stocks, or would you recommend buying at current levels in one go?
So what we have been suggesting is to sort of look IT as a contrarian bet. So while there are definitely headwinds in terms of milder recession in US, I think Europe continues to face problems in terms of growth. Nobody is very sure in terms of how the growth will pan out. But I
Mm-hmm.
think IT has already seen a good amount of price correction. So our sense is that it is a good
Okay.
time to sort of buy IT at current levels. Now,
Mm-hmm.
obviously, stocks will not move in a single straight line. So obviously, you'll have some
True.
corrections in between. But
True.
I think the important thing to also note is that probably towards the end of this year, when this entire effect of the kind of quantum of rate hikes what we have seen gets felt,
Mm-hmm.
I think the
Mm-hmm.
Fed also might sort of turn a bit more softer towards the year end, and
Okay.
because all these hikes will take some time to sort of effect out. So, and our sense is
Mm-hmm.
that towards the second half, you would see some of the Fed commentary sort of turning softer,
Mm-hmm.
and probably that time the price performance could be more. But I think it is a good risk reward at current levels. Somebody
Mm-hmm.
is willing to take risk, I think it is one of the best contra bets at this point in time. If somebody is still sort of seeing or little sort of cautious, I think SIP kind of a mode of investing is good in some of the names or tier one names or tier two names, which I suggest.
Mhm. Talking about the Q3 numbers for HUL, the numbers were in line with estimates, but what dented the stock in Friday trade was that royalty payments to be made to the parent company, which, of course, if you get into rupee term, would be 500 crores only, and the market cap washout today in the market on the Friday session was around 10,000 crores. So, what is your take on HUL?
So yes, numbers were largely in line. We've seen overall 16% kind of a revenue growth, largely led by pricing of 11% and 5% kind of a volume growth. Now the thing is that we'll see a lot of these raw material prices softening, and which is why the quarter-on-quarter margins, both gross profit margins and EBITDA margins, have improved, and that also gives a bit to the company to sort of do higher ad spend and sort of push the growth, especially from a volume perspective. And rural market is also sort of looking supportive. Now, but like highlighted, I think the one thing which sort of dented was the royalty hike of 80 bips. Now, our sense is that this hike will impact the earnings to the tune of 2.5% in FY24 and about 3.3 odd percent for FY25.
Okay.
And that is the kind of price damage in terms of percentage we have seen today. But the challenge is that when you see a stock like this trading at 60 kind of a multiple with an expectation to sort of deliver lower double digit or high single digit kind of a top line and bottom line growth, then that has a sort of a big dampener, and which is why we are sort of maintaining a hold on this stock with a target price of 2,800. So I think royalty is definitely a sort of a big dampener for HUL as of now.
How about the numbers of Asian Paints? You were expecting some kind of a margin expansion. Are you happy with the earnings that they have delivered?
So yes, we are happy with the current set of quarter of earnings what they have delivered. So we were expecting some volume growth, but the market was expecting some kind of a negative growth. So they have delivered zero volume growth. But that is fine because last year, same quarter, they had witnessed a volume growth of 18 odd percent. We have seen gross margins also sort of expanding, both quarter on quarter and EBITDA margins also expanding. But I think the challenge for Asian Paints lies not in the current quarter, but in the future ahead, because one, the company has announced a further capex of 2,000 crores. Now this is on top of the 6,700 crore kind of a capex which they announced. So they are effectively sort of expanding their capacity by 60% in the next 3-4 years. And
Okay.
mind you, Asian Paint is not the only company in the paint which is expanding capacity. A lot of players are also expanding capacity. So now the challenge is that when the stock is valued to perfection, and if while the management is guiding for a double-digit volume growth, but the challenge always is that if so many players are adding capacity, either it could have two implications. One, the capacity utilization could be lower than historic levels. The
Okay.
other could be that there could be a pricing pressure, and which again will have a ramification in terms of the kind of ROEs or ROEs they earn, and which has implications for multiples. And since this stock is already trading at about 60 times, so we have turned cautious. We're not recommending a buy at current levels. I think competition needs to be watched out for price and also on the capacity utilization before one can sort of turn buyer.
PVR Q3 numbers have been good on face of it. If we talk about the profits, they are back into profit from loss, and then their revenues have seen a jump of around 53%. And then we have a big news of merger doing rounds in this counter. So, what is your take on PVR? What would you recommend?
So I think PVR, these or the quarter numbers are good. So because we've seen a good improvement. I mean, when you sort of look at there is a 33% kind of a revenue growth quarter on quarter, largely because one, the footfalls have gone up by 22%, and there is the average ticket prices have also gone up by 9%. And we've seen overall margins turning positive at 13%, but that is the only good part. Now the challenge also is that when you see going forward, especially some of the segments like say for example ad revenues, Now, ad revenues are at still 65% compared to pre-COVID levels. Now, the ad revenues will only go up when you see higher footfalls in the multiplexes, and that will
Okay.
only happen when some of these big Hindi movies deliver. Up till now, largely the challenge is that the kind of sort of boycott campaigns which are sort of going on for some of these big names, so that is sort of
Mhm.
acting dampener. So we are still not sure the kind of revenue potential or revenue damping it can do, and which is why I think while merger formalities are largely done, structurally this stock looks good. But the near-term sort of content and the kind of performance it can sort of deliver, I think that remains a sort of a challenge. Which is why we have maintained a buy on the stock. But next 3 to 6 months, a lot will depend on how these some of the big banner movies do at the box office, and if they sort of
Mhm.
fail to deliver on expected lines, then probably stocks like or both these stocks or something like PVR may not do much. While there are structural positives, I think then we'll
Yes.
have to wait for movies to sort of perform very well at the box office.
Mhm. As far as the price movement in the banking space is concerned, this week was muted, but the results were really fantastic and it was expected. So, talk us through the results of HDFC Bank, which, despite of the good numbers, did not do well.
So HDFC Bank numbers were largely on expected lines. So NI growth 25%, bottom line growth 19%, asset quality was steady. We are
Mhm.
seeing improvement in margins. So from that perspective, nothing negative. Uh, we have turned more positive on HDFC Bank largely because when you sort of look at last 1 year, they haven't really sort of done much in terms of price performance. And now
True.
it's trading at about 2.4 times. So we are sort of slightly more negative on something like Kotak Bank, which is trading at in excess of 4 times, or something like Bajaj Finance, which is trading in excess of 5.5 times.
Okay.
So compared to that, the valuations for HDFC Bank look reasonable, and our sense is that on a combined entity basis, they could witness higher inflows. So it is
Mhm.
kind of a must to have a kind of a stock in the portfolio.
Mhm.
Federal Bank came out with a pretty good set of numbers. So again,
Mhm.
growth was good at 19 odd percent. We've seen improvement in margins. Earlier margin used to be about 3.24, 3.25%. Now the margins are expected to be higher at 3.2 to 3.4%. ROAs are in uptick. Stock is still attractive at 1.4, so we like the stock. Same is the case with IndusInd Bank. Now,
Mhm.
IndusInd Bank overall NI growth was good. I think they are focusing on high yielding segment. The auto book for them did quite well, and they're guiding for 18 to 20% kind of a growth. It's trading at about 1.6 times. Typically, IndusInd Bank in normal times have traded at about 2 time book. So our sense is that if they continue to sort of perform on steady lines with sequential improvement in margins or maintain the growth tempo, then it can
Mhm.
command higher multiples. So which is why we're still maintaining a buy on IndusInd Bank with a target price of 1450. So banking, I think in general there is very little to complain in terms of numbers for most of the banks.
Rightly said. Tata Motors have fundraising plan. They want to reduce their debt in the automotive segment to zero levels by 24-25. What is expected in Tata Motors? Should one really take a position in Tata Motors because the stock has not been performing at all?
Correct. So Tata Motors earlier had guided for that they'll achieve zero net debt. Now the challenge is that when the company guided last time that they're facing challenges in key geographies like say UK or something like China, and they had sort of given that kind of a guidance. So we had sort of pruned down the global numbers. Now,
Mhm.
what is coming out is that when you sort of look at these kind of fundraising, so one is they are looking to come up with an IPO for Tata Technologies where they can, which they can raise about 3,000 to 4,000 odd crores, valuing the
Mhm.
company at say 20,000 odd crores.
Mhm.
Similarly, now they are sort of raising further more money in their EV business. I mean, last time when they
Mhm.
had raised, the EV business was valued at $9 billion. Now it is valued at $11 billion. So
Okay.
all these money obviously will be used for expansion and plus for retiring debt. Now the good
Mhm.
part is that of this entire some of the parts when you sort of look at of the current prices, the EV business is 160 odd rupees. Now, if they are able to raise $600 million, so the per share value sort of goes up to 190 rupees per share. So our sense is that worst is largely behind us, especially for Tata Motors, because we see geographies like China or UK ideally going forward should look up, or Europe should look up. And domestically, they have been sort of doing well. So that way, I think these kind of fundraising obviously goes a long way in terms of telling that the company is seriously committed towards achieving zero net debt, which is what market sort of given up earlier.
What are the key earnings on your radar this week, Pankaj?
So it's a very index heavy, and big names are expected to come up with the numbers right from Reliance. So Reliance again, we are expecting quarter on quarter improvement. So Jio will not expect much of an improvement, largely because the subscriber addition was not that much. So we are expecting about overall 1.5% kind of a quarter on quarter growth. So probably we may not see that kind of a number. I think the overall EBITDA on a consolidated basis could go up by 10%, largely because one, we are expecting GRMs to sort of lead, so oil to chemical business should witness 5 to 5.5% kind of a quarter on quarter growth. Retail should do well, there we are expecting the growth to the tune of about 8 odd %. So both retail plus the oil to chemical business is expected to do well. Geo is expected to be slightly muted because the effect of tariff hike is already behind us. So, but overall decent performance. Axis Bank again expected to come up with good set of numbers. I think we are expecting that you will see a strong earning growth of about 50%. And improvement to margins to about 4%. Similarly, Bajaj Finance, while you will see 23% kind of a growth in NI, but the challenge always is that they've grown pretty faster historically. So this growth might optically look good, but the challenge is that lower than what they've grown historically. And we have the couple of pharma numbers. So supply is expected to come up with good set of numbers, again driven largely by double-digit, good 21% kind of growth in the domestic side. Is also expected to be decent. So that way, I think it is expected to come out with good set of numbers. DRL also is expected to be come out with okay set of numbers, low teen kind of a. And Torrent again, the domestic growth is expected to be quite good at 21%. It's largely a domestic focus player. And last but not least, Maruti. So Maruti, you will not see quarter on quarter growth because the volumes have dipped at 10%. But since the product is better, so we'll see 5% kind of a growth. But I think the good part is that the margins will come in double digits. The company has been sort of really battling in terms of margins. So I think that should sort of be a positive surprise.
Let's now talk about the hidden gem. So which is the stock that you are going to share with our viewers as far as the hidden gem is concerned?
So we all know that this week only IT has sort of done well. IT is one sector which is sort of turning around the corner. The management commentary across most of the companies have been good. We've been longing to give IT for a long period of time. But now we have sort of sufficient ammunition to sort of give. So which is why I'm recommending Persistent System. Here our target price is 4,920. So at about 26 times FY25. Now this is one company which offers cloud data products and other services to BFSI, healthcare and high-tech verticals. And they've seen last year was pretty strong, about 35% kind of a growth. Out of that, the growth was about 32%. Obviously, IT companies do not have debt, so that is really not a challenge. Now, this particular quarter, they've seen a growth of about 3.5%. Now, our sense is that overall there has been an impact of furloughs, so which is why we would expect growth to be better in the coming quarter. And like I said, most of the IT companies have come up with good TCVs. This company has witnessed 20% kind of expansion in total TCVs. And our sense is that the top client is going to sort of help this company maintain a good growth momentum of say 24%. So we expect dollar revenue growth to be 24%, margins to expand at about 15.6%. And this is one company which is talking about they have been getting price hike from many customers. Plus, they have been acquiring companies earlier. They are still not shying away from acquiring companies which will add to their capabilities. So overall, a very confident talk from the management. I'm pretty confident on the growth front, so which is why I'm suggesting this stock with a target price of 4,920.
So after a long, long time, we have IT stock as a hidden gem this time. So Pankaj, what is your strategy for next week? Would you say stay stock specific?
I think Nifty is not doing much. I mean, when you sort of look at the overall market volumes, especially on the cash side, that is still sort of lower. So our sense is that Nifty is going to sort of consolidate, and the good part is that it is holding key levels, and FI selling is sort of tapering off. So in this kind of a construct, our sense is that with the kind of heavy result season which is sort of panning out, so we would expect more of a stock specific move depending on which sector sort of comes out with, or which stock comes out with good set of numbers. So largely a very stock specific move is what we would expect next week. While Nifty again is consolidating at a higher level, but breakout is yet sort of some time away probably.
Thank you, Pankaj, for being with us. Appreciate your time.
Thank you so much.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.